Hope you had a great lunch. Also, for my part, I have to say I really missed the regular EFAMA conference lunch. So hopefully next year we will be able to do this in person and have that proper lunch. And all the more importantly, to meet all of each other. That's always a great part of this conference, really to engage with all the colleagues from around the world and Europe to this annual gathering. Our next guest, Paul Stevens, hardly needs any introductions for this audience. Such a prominent figure, he has been in our industry the last decades. Paul is President Emeritus of the Imaging Company Institute, and since 2004 until last week, actually, Paul served as President and CEO of the ICI, and he is now retiring after 16 years of service. Paul steered ICI during some of the most challenging years in its history through the financial crisis and beyond. Paul also served as General Counsel of ICI already from 93 to 97, and he actually told me that he attended his first meeting with FEFSI, EFAMA's predecessor, already in 1993. So Paul is a longtime friend of EFAMA. During Paul's time at the ICI, there's been a close dialogue between EFAMA and ICI, with regular meetings in Washington and Brussels to compare notes on evolutions on both sides of the Atlantic. Paul, it's a real pleasure to have you here today to tell us your insights on key issues for the global asset management industry. Thank you very much for accepting our invitation.
Jarkko, thank you very much for the invitation. This will actually be my last public appearance while at the ICI, and I'm very, very happy to be winding up this long career among my European friends and colleagues. So I'm very grateful.
Great to have you. We have many topics to discuss in this short period of time, so let's kick off. It's been a really different year with all the COVID caused troubles for human suffering, but also issues for our industry. So let's start with COVID-19. And this pandemic has had severe repercussions on financial markets, provided the real stresses for our industry. What are the lessons you draw from this episode, Paul?
Well, Jarkko, I think first and foremost, we've proven to be extraordinarily resilient in the face of this pandemic. And I think globally, funds and their sponsors have continued to keep their promises to their clients. And I think that's extraordinarily important and a great testimony to all those people who worked on business continuity and other issues that have allowed us to do that. The regulators are trying to draw conclusions and observations from all this too. And I think we're trying to address those in a series of reports at the ICI about the experience of regulated funds during the pandemic, particularly in those incredibly volatile months of March and April. I think it's really important for us to understand what happened during that period of time in order to draw the right conclusions. It's quite different from the great financial crisis. In March, the turmoil in the financial markets flowed directly from the pandemic itself, of course, but also the steps taken by governments around the world to curb the spread of the disease. The response to this public health crisis damaged first and foremost the real economy, and then spilled over into the financial sector in a very short period of time. By contrast, of course, the global financial crisis was a credit crisis caused by a housing bubble, which led to the failures of dealers and banks and then spilled over into the real economy and played out over 2 years. Why is the distinction so critical? I think policymakers no doubt will be considering whether and how to bolster the financial sector's resilience to massive shocks, and reforms appropriate to address the global financial crisis may or may not be appropriate for this one. Another important lesson relates to the sequence of the events that we saw in financial markets. Much has been made of the redemption pressure on money market funds and perhaps bond funds, for example. But actually, the dislocations began in the US Treasury bond market and then spread to other fixed income markets before funds came under any redemption pressure. So a quite different set of circumstances than those that we faced in the great financial crisis. And it's important to understand them to draw the right lessons.
Absolutely, and as you say, there's a lot of attention by the regulators on these issues. Some of them suggest that the COVID-19 induced financial crisis indeed revealed weaknesses in certain parts of our industry, like money market funds, ETFs, especially on liquidity management, which you alluded to. and they are calling for certain kind of macroprudential tools to be put in place, liquidity buffers, for instance. What's your reaction to this? Are these the right tools? Is really the reaction we need from regulators at this stage?
Well, you know, I keep hearing this phrase macroprudential tools, but it's rarely particularized. What does exactly that mean? If it means regulating funds as though they were banks, then I have real reservations about it. In any event, bank regulation would be inappropriate for money market funds and for ETFs. And contrary to the opinions of some observers, what our research into the market events earlier this year indicate is that neither money market funds nor ETFs trigger the financial market turmoil. Take ETFs, for example. Even during the worst of the turmoil, the ETF ecosystem acquitted itself quite well. ETF shares traded smoothly and efficiently on the stock exchanges. ETFs acted as a price discovery tool for investors, and authorized participants and liquidity providers stepped up to facilitate an unusually high volume of ETF activity. All of those concerns about ETF, all those grave predictions, really proved not to be true. As for money market funds, it's true that there were serious widespread dislocations in the short-term credit markets, as well as other fixed income markets. But they happened before money market funds saw redemption pressures. In fact, a wide range of markets experienced dislocation, many in which prime money market funds are not significant players. In addition, in the United States market, overall, the U.S. Securities and Exchange Commission's reforms in 2010 and 2014 resulted in a much more resilient money market fund sector. Institutional prime money market funds, for example, saw considerably smaller dollar outflows. They were substantially more liquid. They saw much smaller reductions in their holdings of commercial paper, and they made much less use of the Federal Reserve liquidity facilities during COVID-19 than during the global financial crisis. Now, all that said, one of the principal 2014 reforms of US funds, money market funds, which gave fund boards the option to impose liquidity fees and gates if a fund dipped below the 30% weekly liquid assets threshold, may actually have intensified pressures from institutional prime funds instead of moderating them, because it essentially meant that you had 30% liquidity that you really couldn't use. Someone's characterized it as a concrete airbag, not a very practical thing. So I hope that there'll be a re-examination of some of those reforms in the U.S.
Indeed, one thinks that many of the steadily regulated central banks seem to think that this is a too good a crisis to miss, in terms of again saying that asset management is the next source for systemic problems and risks. You played an instrumental role some years ago in convincing the prudential regulators across the globe that asset management companies, whatever their size, should not be regarded as systemically relevant entities, nor designated as G-SIFIs. Do you think this debate is over, or is it coming back with the COVID market crash and central bank saying that actually they saved us from ourselves?
You know, Jarkko, I'm not sure the debate will ever go away. I remember very vividly during the financial crisis, I got a call from Paul Volcker, who was the former chairman of the Federal Reserve of the United States, and he asked me to join him for dinner. And he began, I didn't really understand why the former chairman wanted to see me, but he explained that what you do, when he was talking about asset management and regulated funds in particular, has become relatively more important over time. And what banks do has become relatively less important over time. And that's why we, and I took him to be referring to the Fed, need to regulate you. And I think that's the simple explanation. This is a kind of a bureaucratic imperative that central banks feel because of the success of our model of financial intermediation and the growth of regulated funds. I think it's really important for those who take up this debate after I'm gone to make sure that they're doing it with really data-based, empirically driven observations and understandings of how our industry works. As I said many times, long-term regulated funds and their managers have never posed risks to the financial system at large, and we can document that in one event after another. And designation for central bank regulation would be very ill suited to our products and potentially extraordinarily harmful to the millions of investors they serve. And if that's the case, ultimately it'll be economic activity, jobs, growth, enterprises upon which our societies depend will be the losers.
Couldn't agree more, Paul. And I think that's a perfect pitch to our next topic, which is Capital Markets Union, in terms of how the growth in Europe and of course globally needs more and more capital markets. And of course, we are very envious, as always, for the US, how developed capital markets you guys have. In the EU, we are now having the second iteration of the Capital Markets Union Action Plan. And retail investors are really at the heart of this issue. So much money still lies in bank accounts, zero interest bank accounts in Europe. So US been doing so much better in this area for so long. What advice can you give us in Europe? How to go about this Capital Markets Union? How to really get bigger share of financing for the economy from the capital markets?
Well, you know, it's a long tradition in the United States. I mean, it really began in our earliest years when we had banking and we also had capital markets. The capital markets part began under Hamilton as Treasury Secretary, and when he created a market in U.S. government securities, which in turn were purchased by some of the earliest mutual funds that were organized in Europe. It's an amazing story. If you tease apart the U.S. experience more recently, however, it's clear that one of the greatest drivers has been the private sector retirement system of the United States, and in particular, 401k plans and individual retirement accounts. These are workplace sort of third pillar pension arrangements, which have been extraordinarily warmly embraced as a additional savings tool for retirement. If I look at Europe, I think that many of you have spoken so eloquently about the need for something of the same sort. And the idea of a personal portable pension product, the PEP, is an incredibly sensible one. And I think it would be embraced just the same by so many Europeans. But as it's been developed so far, I think it's going to fall short of its potential. Mm-hmm. What you need is a practical PEP. That means policymakers must provide more flexibility about how fund managers can design investments for using it, including risk-based investments, because you don't get the long-term returns without an element of risk. And ultimately, and I know how difficult this is, craft a workable tax regime for it. A more practical PEP, more widely used PEP, would provide EU citizens to direct more of their savings into market-based instruments. It would alleviate some of the pressures on traditional pensions, which I think is important in your society, just as it is in ours, and would help as a source of financing to the real economy in Europe and diversify away from banks, which has been, at least nominally, a very important policy objective for you all. But the actions around achieving that objective have, I think, fallen far short of the aspirations.
And I think fully agree. And I think national level is key here. I mean, EU is doing a lot, but a lot depends on the fiscal treatment at national level and what the national governments do to promote pension savings. It's highly political issue in many member states. So can you see that this 27 country union could ever even approach what you have in the States, being one country, also a very big country, but this divergence of approach at national level, can we overcome this in Europe? What's your advice and thought on that?
Well, I think it's certainly worth working toward that, and I understand the difficulties involved. The United States is a country that has 50 different jurisdictions, our states, and some of them extraordinarily large. I was involved in the 90s in an effort that was successful in the Congress to get the states out of the regulation of mutual funds. Federal law preempted them, essentially. We have a mechanism to do that. It's far more cumbersome for you all to do it. But because of the commonality of these issues, every society around the globe, I think, not just every European member state, is worried about the ability to provide for an aging population and need to find more tools with which to do that. that ought to galvanize, it seems to me, political leadership across Europe to take some very bold steps to address the issue. And I hope that it will.
Absolutely, very much agree with that. Okay, we have many topics to cover, so let's move on. Global nature of the investment funds and industry and possible threats. Over the years, our industry has become increasingly globalized. In light of geopolitical developments in several parts of the world, are you concerned that this trend could be slowed down or hindered by market fragmentation, increased protectionism, decreasing influence of multilateral institutions? And what would be the impacts of this deglobalization, so to speak, in particular for investors in terms of cost and choice?
Well, I think there are a lot of centrifugal forces at work in the world today. You see them virtually everywhere. The rift between the West and China and Russia continues to deepen. Brexit has, I think, unleashed some very unfortunate forces cross-channel and really globally, where Europe is, I think, trying to use its regulatory powers and the attractiveness of its economy in ways that it has not before. There are certainly similar developments in the United States under this current administration. We all know about the trade disputes and the issues regarding the WTO, and you could go on and on. The list is very, very long. If these trends continue and deepen, the implications of deglobalizing for investors, I think, would be very troubling. They would have less access to foreign markets and to the talents and abilities that foreign managers and foreign service providers can provide. I think that would increase costs because it would begin to fragment markets, and it would ultimately produce a narrow choice of fund products. So I think we need all to be concerned about these trend lines and to do what we can to try to maintain a greater degree of openness and harmonization of regulation and the like, and to encourage regulators and policymakers to reach out to one another and see if they can't find common solutions that ultimately benefit the underlying investor. But taking a long view, I think the forces that propel globalization are not going to be so easily stopped. They may be retarded for a period of time, but in many respects, I think continued integration of economies around the world is almost inevitable. Over time, the flow of goods, services, information, and capital is going to overtake the barriers that nations erect. So I also remain confident that fund investing will continue to expand around the world. That's been really one of the remarkable aspects of my career. I started in as a young lawyer in the late 70s when money market funds in the United States were taking off. And so the trajectory of my career has really seen the development and growth of the global fund industry, and certainly that in my own country. As I travel around the world, as I have with ICI Global, the thing I perceive is that nations are all increasingly realizing that the development of a successful fund sector is a crucial ingredient for them in growing their economy and diversifying the sources of finance, encouraging startups, providing resources for aging populations, all this and more. So far, this has proven to be an extraordinary opportunity for global asset managers to help meet the needs of a whole new world of investors. And it's one that I expect they'll continue to pursue with some success. Among my last trips abroad before the pandemic, I met with the chairman of the Chinese Securities Regulatory Commission and all of his senior staff. And we talked about the market opening efforts in China. That's a remarkable development, and it signals China's determination to become a major fund jurisdiction and to use funds, among other things, to help with their own aging population. So the trend is really, truly right across the world.
You already alluded to the delegation issue, but obviously there's been a big discussion, a lot of concern in Europe after ESMA's letter in August on the FMD review and a delegation, of course, which is at the real heart of the UCITS business model. How concerned, how worried are you that this will really lead to something that would endanger the current business model of how we are able to pick the best portfolio managements wherever they are seated, in the world, to use its products. How worried are you?
Well, I've always been envious of the European Union for having its UCITS as a model for regulated fund investing, and in particular, its embrace globally as an investment medium is something that has been an extraordinary accomplishment for the European industry. United States mutual funds are purely domestic products. We don't export them the way that you are able to do with UCITS. And that kind of success, global success, is rare. And I think there's nothing that says that it will always be the case. But policymakers in Europe ought to be very proud of it and try to encourage it rather than the opposite. And unfortunately, the idea of curbing delegation and, if you will, onshoring those activities that support UCITS is something that if Europe does, well, why wouldn't other countries choose to do it too? In meetings in Hong Kong, for example, it was very clear to me years ago that they were determined to try to develop their own fund sector, and not just administrative, but also portfolio management and other things. So here's again a potential for fragmenting the marketplace. As part of the success of UCITS, I think the manager's ability to delegate portfolio management and other key functions to experts outside the EU is an important part of the success story. And hemming in that ability would stunt UCITS' continued growth. I'm convinced of this. It certainly would disrupt the operations of global asset management firms. And it would deny investors, and this is really where the focus always ought to be, what's good for our investors. It would deny them access to the investment expertise that they expect and deserve, the very best in breed. And that's really what I think we owe to them. This isn't, as you know, the first time we've been through these discussions. Last year, we were encouraged to see EU legislators reject a provision that would have empowered ESMA to limit UCITS managers' delegation. But with the issue back in play, I think we all ought to once again be fully engaged with it. And I'm sure that IFAMA and certainly ICI Global will advocate vigorously against any proposal that would bar UCITS from enlisting top talent in the service of UCITS investors, wherever that talent should be found.
Absolutely, Paul. Certainly, IFAMA will do all it can, to prevent this from happening and let's say destabilizing the business model we have to support our clients. It's in the interest of the clients, really that we can pick the best portfolio manager wherever they are. Apart from delegation,
Jarkko, I just might say, one of the things I've tried to do as president of the Institute over those 16 and a half years is ask myself, with respect to every policy issue, what's in the best interests of our shareholders and investors? And that's got to be the star by which we steer always. And it's very clear to me what the answer is with respect to the delegation issues.
Absolutely. Apart from delegation, on the UCITS model, is there something else, sort of advice you would give us in Europe, how to preserve that really, because it's been a huge success. It's the best retail product EU financial services regulation has developed. I mean, it's a huge success globally. So how can we preserve that, even develop it further? Any thoughts on that?
Jarkko, am I correct that the UCITS directive was one of the very first directives adopted by the European Commission? I think that's true. At least that's what I've always been told. And I've been around these debates for a very, very long time. Cross-border distribution and harmonization across the EU and that sort of thing. It's always been less a practical reality than it has been a theoretical one. And when we preempted state regulation of mutual funds in the United States, it really made it a global, a national marketplace. A manager located anywhere could market funds from Maine to California and from Florida to Alaska. And it created enormous opportunities. Distributing UCITS across member states in the EU remains, to this day, despite all the efforts, far too costly, far too complex, and far too confusing. And an uninviting environment like that discourages firms from offering their funds across borders. It explains a lot about why so many funds are sold in only one or a few member states. And also, importantly, why on average, EU funds are so much smaller in size than they are certainly in the United States. So streamlining and harmonizing member states' rules, especially around fund marketing and authorization, would enable UCITS managers to reach citizens across the continent simply, efficiently, and inexpensively. It would increase competition and frankly, provide scale economies for investors. That would mean for retail investors, a broader selection of fund products to choose from and lower charges to purchase their shares. So it's truly a win-win situation. So I think in addition to that, there could be some work done to modernize the regulatory regime around disclosure. As it stands, as you know, UCITS funds must send retail investors multiple needlessly complex disclosure documents, which are difficult to understand and often inconsistent across member states. So harmonizing rules in that area is also part of the answer. So a lot to do, but a few simple steps like this, I just say simple in the sense that they're straightforward from a policy perspective, complex from a political perspective. Doing those would transform the fund marketplace in Europe, and I think enlist a lot more retail participation.
That's a good to-do list you're leaving us, Paul. Thank you very much for that. But yeah, a couple of minutes left. Let's focus on the big picture then, really the mega trends. I mean, you've been observing our industry last decades, and what's been the most striking evolution in terms of this, of course, huge growth after the financial crisis even, but what's been the most surprising, let's say, and evolution you witnessed?
Well, I think it's the scale of the industry, as you indicate, and also the scale of individual firms. The growth really has been remarkable. And at the end of 2008, for example, regulated funds across the globe held less than $22 trillion. At the end of this June, they held nearly $54 trillion. That's an average growth rate of over 8% annually. Pretty extraordinary. And we can glean, I think, one striking evolution right from this growth. Over time, regulated funds have become an altogether increasingly important factor in global financial intermediation. In my way of thinking about it, they now stand among the most successful aggregators and allocators of capital in the history of modern finance. The other thing I think is important is all the constant innovation in the industry. That's been a characteristic, I think, throughout all of this period of my involvement. Increasingly innovative fund products offered to investors. The surge in ETFs and index tracking products is part of that story, but it's certainly not all of it. There's now growing interest, for example, in sustainability and investing in accordance with sustainable guidelines. I think that more and more countries around the world are going to be implementing account-based retirement system provisions as tier 2 or tier 3, and funds will have an important role in that. They've proven their worth in that regard. And of course, we've talked about the globalization of the industry. So Jarkko, as I look back on my career, it's singularly fortunate, I think, for me, that I caught this wave of funds and fund investing. And like so many things in one's career, it was entirely accidental. There was nothing premeditated about it. But I thank the good Lord for giving me that opportunity, because it's been quite a ride.
You picked a good wave, yes.
Yes, indeed.
We have one question from the audience from Pierre Boulogne. A debate is building up in Europe on the growing market power of data providers. What about the US discussion on this? Data providers and their position.
You mean market data? Is that what Pierre is referring to?
Yes.
The issue is one that's hotly contested in the United States, just as it is in Europe. But I think the attitude of the fund industry is very clear. In a sense, the data about trades and activities on markets is really, in a sense, the property of the asset managers who are involved in the buy side of the business, and the sell side wants to arrogate it without much regulation to its own purposes and exploit it, selling it back actually to the people who create it for profit. I think that capital markets regulators need to take a very, very close look at that. And I truly do support the efforts in the United States and in Europe to try to make sure that that data is readily available to the market because of the efficiencies that it provides to the buy side of the business.
Absolutely. I would like to hear your reflections on ESG, sustainable finance, on the US side.
We've been spending an awful lot of time talking about ESG and following the sort of breakneck pace that the Europeans are setting in terms of moving towards that. The United States, I think, is not quite where the EU is on these issues, and that's not to say that there isn't a recognition that the financial industry has an important role in helping to promote a favorable environmental and other outcomes. It's just the question of how you move in that direction. And it'll be interesting to see what the new incoming administration, the Biden administration, will do. I think it'll pay a lot more attention to sustainability issues in the new administration and at the next SEC.
We have 2 minutes left. Paul, your reflections, opportunities, challenges for the industry globally. 2 minutes, next 10 years. What will you say?
Well, we touched on any number of them. Yeah. I think one of the things that's very important is for the associations that represent global fund managers and asset managers work very closely together. I've found that the dialogue that we engage in to be extraordinarily useful. One of the biggest costs of having a global mindset is just the information cost, understanding what's happening in other markets, particularly in political systems, cultures, legal systems that you don't know as intimately as you know your own. And we're all facing common problems. We're all facing common challenges. And certainly the regulators are all talking to one another. So it seems to me that we need to stay in very, very close touch in order to understand what the developing policies, if you will, industry practices and industry challenges. It's a community at the end of the day, and we can all help one another to keep the neighborhood as nice and safe as possible. And so I think certainly ICI has always been committed to that, and my sense is AFAMA and you personally have been as well, Jarkko. So that is the one piece of advice I would leave as I go into my retirement.
Thank you, Paul. That is perfect conclusion to our discussion. I warmly want to thank you on behalf of AFAMA for all the good cooperation over the years, your friendship, so many friends you have in AFAMA, and I'm sure we will be happy to see you around in the years to come in various circumstances. Thank you so much also for this session, really enlightening to hear your thoughts. So warm thanks, Paul, and all the best in your future endeavors.
The only thing that would have made me happier, Jarkko, is if we could have been sitting together at a stage and I could shake your hand, and Tongis and so many friends there in Brussels. So I pray that this forum next year will be in person, and wish you and all your colleagues every success and happiness in the years ahead.
Thank you. Thank you, Paul. Thank you all. Be safe. This concludes this interview with Paul. A lovely session, really, really valuable discussion. The next session and the last session of the conference is a legal workshop with Deckard on hot topics and trends in US regulation on funds and asset managers. So join the workshop at 3 o'clock, and then the event, the forum will be over. Thank you very much for my part for attending and attention. Have a good rest of the conference. Thank you. Bye-bye.